On to journalizing, transactions in Chapter 2. Okay, folks, when you go back to the end of Chapter 2, back to that demonstrative problem with Jasmine Worthy and her haircutting business called Expressions, I want to make sure that we're okay with how to journalize. Some of the images in your Chapter 2 book are taken from computer software programs, and they look a little bit different than what you should be doing with your journal pages and writing. Okay, so if you want to follow along, you can open up to the back of Chapter 2. But basically, we have letters A, B, C, D, all the way through K, telling us things that have occurred during the first month of business. So on August the 1st, it says Worthy invested $3,000 cash and $15,000 of equipment and Expressions. Okay, so as we are finding out with our Chapter 2, Analyzing, there is a 4-step process. Step 1 is to identify the transactions in the source documents. In our class, we're not going to have actual source documents. What they give us in the instructions is going to be our source documents for us. And business, bank statements, invoices, receipts, bills, that sort of thing would be the source documents. For us on A, our source document is Worthy invested $3,000 cash and $15,000 of equipment and Expressions. Okay. So now step 2 is to analyze the transaction using the accounting equation. So the next step is to go through and decide what happened here. Well, it looks like Jasmine gave her business some cash and some equipment. Okay. And as you learned in Chapter 1, when a person gives assets to a business, they now have claims on the business for those assets. Okay, now because we're going to work on journalizing, we've got to understand account titles. Okay, also please make sure you go back and look at the chart of accounts in Chapter 2. And every business is going to be different. So if you look down under the required, it says open the following ledger account balances in column format. Account numbers are in parentheses. So every account must have an account title and an account number. So we have cash, which is account number 101, then accounts receivable with a number, furniture with a number, store equipment, notes payable, J. Worthy capital, J. Worthy withdrawals, haircutting, services revenue, wages expense, and rent expense. Okay, so those are the only accounts that Expressions has at the moment. So when we're looking at these transactions, we have to use these account titles. So she invested $3,000 worth of cash. Cash is our cash account title, and $15,000 of equipment. Now we don't have an account named equipment, but we do have an account named store equipment. So that is the account we're going to use for that $15,000. And then also, because Worthy invested it, we're going to use the J. Worthy capital account. Okay, so we've now analyzed the transaction and decided what accounts we're going to use. Now let's see how that affects the accounting equation. Okay, cash. Cash is an asset. Cash is, if she's investing cash, that means cash is increasing. So going back and looking at the accounting equation, with your debits and credits, what side increases cash? Okay, that's the debit side. Equipment. The business now has $15,000 worth of equipment. So what is equipment? Equipment is an asset. Okay, we're actually going to use store equipment as our title, and that is going to be increasing, so that means we're going to be debiting store equipment for that $15,000. Okay, Worthy gave both of these assets to the business, so now she has a claim of $18,000 on the business. So if we go look at the journal transaction, okay, and a few things I want to go through with everybody. Okay, here is the date column. Okay, You can abbreviate the date for each one of the months. Please do not use numbers for the months. Just use an abbreviation. This is the one place where you can abbreviate for your months. Okay, so we have, and actually I think your pages look more like this. So August goes in the first column under date, and then the day of the month goes under the second column under date. Then the next column is account titles and explanation. Okay. The next column is the PR column, which stands for post referencing. Then your debit column and your credit column. Okay, one thing that this is missing is this is a general journal. And this is page 1 of the general journal. Okay? So what we're going to do is transfer that information that we have thought through and processed and go on to step 3 to actually record the journal entry. So cash is a debit, store equipment is a debit. So we're going to always record our debits first. Whether we have 1 debit, whether we have 2 debits, whether we have 10 debits, we will record our debits first. Cash doesn't necessarily have to go first. As long as you pick out a debit account, we could have had store equipment go first. Okay? Just as long as we put all of our debits down first. Then after our cash, go to the debit column and put in the 3,000. Store equipment, and then go put in our 15,000. Now for our credit, okay, and basically the line, you want to keep your debits close to the line that starts the column for your account titles and explanations. And then you just want to indent like a tab if you were to be typing up in a Word document. So you just want to go over a little bit to put in your credits. Okay? In this case, we only have 1 credit, our J-Worthy Capital, which is the total amount that she invested in the company. Okay, the 3,000 cash and the store equipment of 15,000. Okay, now notice I had blocked out the post-referencing column. Nothing goes in this column until we actually post to the general ledger. Okay, so what we're going to do is we're going to go to the general ledger. We're going to find cash. We're going to date it August the 1st. We're going to use the debit column to put in the $3,000 debit, and then we're going to tell it in the post-referencing column on the ledger, where did this transaction come from? It came from the general journal, page 1. Okay, so if we look down here at the general ledger, here is cash, August the 1st. The post-referencing column is G1. It was a debit that we did of $3,000 on the general journal. So it's going to be a debit of the $3,000 and then bring a new balance. Because there was no balance before, it now just has a $3,000 balance. We're going to take account number 101 and we're going to come back here just a second. Pull that down a little bit. All right. So now we come back to the general journal and we post 101 in the post-referencing column that lets us know we actually posted this cash amount of $3,000 to account number 101. And this is very helpful for us to find our errors. Okay, store equipment. August the 1st, General Journal, page 1, debit of 15,000, balance of 15,000, account number 165. We post right here to say, yes, we posted this $15,000. Okay. Next to J. Worthy. So back down to J-Worthy Capital, August the 1st. It came from General Journal page 1. We credited it 15,000, so we're going to make sure we put it on the credit side and get our balance. Then take account number 301 and place it in the post-referencing column. This just lets us know that this is where it got placed. And as you'll find when you go through and work chapter 2, you might come out you're not in balance when you do your trial balance that we'll talk about in a minute, making sure our debits equal our credits. This is where we go back. So please don't just go through and start writing in numbers without posting to the ledger. That will really slow down things and take a lot of time for you to find your mistakes. Okay? Go through, record your transaction, then post to the ledger. Don't try to go through and find all the cash and do all the cash and then go through. Take it line by line by line. You won't miss anything that way. Okay? So once you have gone through and analyzed every single one of the transactions, okay, it says on the second there was a furniture as a debit and cash as a credit. Let's go look at that and see what it said. On August the 2nd, Expressions paid $600 cash for furniture for the shop. All right, so we paid $600 in cash, and there's our keyword right there. So what's happening to our cash? Our cash is going down. Okay, why did we pay out $600 in cash? Because we bought furniture. What type of an account is furniture? It is an asset. And now we have furniture, so our asset account is increasing. Okay. So how does an asset increase? With a debit. Cash is an asset. How does an asset decrease? With a credit. Okay, so now you should think to yourself, okay, furniture is my debit because furniture is an asset and it increases on the debit side. Cash is an asset. Cash is decreasing. Assets decrease on the credit side. So that's why we have furniture is our debit, cash is our credit. And notice in each one of these accounts, debits get recorded first. Okay, rent expense is a debit, cash is a credit. And notice everything lines up as well. Okay. Keep your, well, I know my line's not real straight, but keep all your credits lined up. Okay, it becomes very tiring on the eyes to bounce back and forth, especially if you've started a credit instead of notes payable starting right here, if you started it right here. That's a lot for your eye to have to go from here to here to here, here to here to here, back and forth and back and forth. It becomes very tiring. So just slightly indent your credits. You want to just indent them enough so that a person looking at your page would understand that that is your credits.